18,300 is where we're at. Aman Chowhan is fund manager at Abakkus Asset Management. He's joining us now to take some questions. Aman, good to have you with us here. Thank you for your time. I mean, earnings are still coming, and this is an extended earnings season, full year. So we will still get many more, but many have already reported. From your portfolio companies, Aman, what has really blown out the lights? What has disappointed? Just give us some color. Aman, you'll have to unmute yourself.
Sure. Hi, sorry. Yeah, so I was saying most of the portfolio companies have reported inline numbers. The disappointment come predominantly in the chemical sector, where there has been a margin pressure. There has been some slowdown in the top line in the consumer sectors also. Banking financials have been much better than what we expected. So that has been a good silver lining for us. Some of the building material companies have shown good improvement. Cement companies have reported better than what we expected. So I'll say 80% of the portfolio have reported in line or better than what we expected. Chemicals would be the only disappointment which I can think of.
Chemicals being the disappointment. Okay, Aman. So tell us, for you, has there been anything which has been an outlier, a pleasant surprise, something that's getting your attention enough to maybe take a fresh call in terms of fresh deployment?
Financials, microfinance is something that has surprised us on the positive. We are positive. We have our exposure in the portfolio, but the numbers and the growth have come in much better than what even we expected. We are seeing good bottoming out happening in some of the building material companies that we have, which were facing margin pressure. So with coal prices down, freight down, oil down, these companies are now started to recover on the margin. So this has also been a good positive surprise and something that we would like to add to exposure. So these two, I believe, would be the focus points during the earnings season so far. IT has been a mixed bag. We have seen good amount of money moving from large cap IT towards mid cap IT. Both the mid cap IT companies that we have in our portfolio have reported better numbers, and that is also being a good pleasant surprise for us.
All right. Hi, Aman. In fact, earlier today, I spoke to the management of that Somani Group company that you track, closely, and it's hit a fresh all-time high. Hindware Home. I think that was part of your portfolio. It's done quite well. So I guess if you're still holding it, then great news out there. But I recall you saying that you're gradually increasing your exposure to pharma as well. Tell us more about that, because some of these names, Divi's Laboratory, you've seen Piramal Pharma, JB Chemicals, some of these names, I don't know whether you'll own any of them. But the street has started looking at it on a sequential basis. If the margins have improved sequentially, the street likes it. Even Loris, in fact, is up nearly around 10% from the recent lows. Your take?
We are in the same camp. See, there are two sets of pharma companies. One which benefited out of COVID. Now on that high base, they had a very low or say degrowth in profits because the COVID benefits are now going away. And now they are bottoming out and now starting to look up again. So this is one set of companies that we are pretty positive on. The second set of companies are the raw material consumers, which used to come from China. So because of this COVID disruption, obviously the margins took a hit. And now with the supplies resuming from China, the API and the raw material costs are back to normal. And hence the margins have started to move up. At the same time, things have bottomed out in the US. So these are the three factors that are playing in the market. And this is the segment within the pharma space that we are looking at. What we are clearly avoiding is companies with export focus, where there's one-time gains of some molecules, or where there's still some pricing pressure in the US markets and the margins are not yet come to a bottom level, or there's still some margin squeeze yet to be done. So that is the segment that we are clearly avoiding. So based on this, we are looking at some domestic names. We are looking at some mid-cap pharma names, which has a decent balance of both domestic portfolio as well as exports. But the underlying theme is that wherever we see a margin recovery, both sequential, most of them it is sequential for now, because whatever I think will take another 1 or 2 quarters, but earnings growth is where the focus is, led by the margin improvement, which many of these companies are seeing.
Aman, last time you told us that the rally in the auto stocks was more tactical, because we've seen a softening in the raw material prices. But the numbers are actually looking pretty good across the board. Would you look to change your stance on auto and perhaps become a structural bull? And if not, then what's the reason for that?
Not yet. So, not owning autos has not been favorable to us so far, but we are holding on to a view that most of the companies are not prepared for the EV, and it's a writing on the wall. We all know that. And the kind of valuations the global companies are trading at compared to that, when we look at the Indian companies, then it's completely out of sync. So, Indian companies are trading at 3 to 4x the valuations that the global majors are trading at, and they are much better prepared on the EV front than most of the Indian companies. And within India also, the companies that we look at, for them, the EV component is pretty small. So, and hence, for now, we are holding on to a stance that let's keep minimal or zero exposure to auto. Maybe in next 2-3 months, we'll like to have a revisit on our stance.
Yeah, the point about microfinance companies is well taken, Aman, and absolutely, even smaller, lesser track companies like Saturn, the larger ones like Credit Access, they've all reported very good numbers. Are valuations still very reasonable? Can you may be holding it for a while, but for those who want to enter now, how are valuations looking?
See, these companies have at least a 2 to 2.5 year cycle. We are just at the start of this cycle. Based on this, the mid-sized companies are all trading around 1 to 1.5 times book. Some of the companies are also trading closer to 1 time book. And with in an upcycle, these companies have an ROAs exceeding 4 to 5%. They have ROAs exceeding 20%. That they can easily trade at 2.5 times book. So from that perspective, I still feel there's enough room for valuation re-rating in most of the companies. Maybe wearing the top company, which could be trading around 3.5 times book. But anywhere, any company trading closer to 1.5 time book can easily re-rate to 2+.
Okay, that's microfinance. Since we are talking, financials on the smaller side, let me get your view on the big boys as well, Aman. The kind of selling that we've started seeing in bank stocks, for instance. Now, I'm not sure if this is just tactical selling. Sectors had a great run. There are global uncertainties, or whether this is more strategic, because there is a view in the market that the best of the margin expansion and the best of the profitability is perhaps behind us. What's your sense, and how are you sort of placing the bigger financials in your portfolio?
So we are holding on to the large cap financials that we have. While that can be a slowdown from a higher base, but from a risk reward perspective, they still offer decent return. So yeah, we have had a decent multi-bagger return over a 3-4 year period for even from the likes of ICICI Bank. That is not something that is going to get repeated, but a steady 15-20% growth from these companies or these banks. Based on what the earnings growth they are still likely to report over the next 1-2 quarters and 1-2 years is what one should be expecting from these names. So based on that, we are still holding on. We are not reduced our exposure within the financial space, both either for large caps or for mid caps.
All right, Aman, just hold that thought. The Nifty has broken that 18,275 odd mark. At around 235, we said that, that should be the mark that the bears will be looking to defend. And if they don't defend that, we could easily see 50 points on the upside. We have done already around 40 points on the upside. Just take a look at that. The minute we broke that 18,275 odd mark, we're seeing a big fillip on the Nifty itself. So just keep an eye out. If we can sustain on these levels, the positioning was such that the 18,250 call was getting written. So that's why those that were called short, they are getting trapped on the wrong side. But we need to sustain this market. It's already around 3 odd, 27 minutes to go before this expiry plays out. Well, Aman, just need to take stock of the markets. But, you told us the last time that metals, you'll be sitting on the sidelines. I'll tell you what, this week we've got so many metal companies that came out good set of numbers. Whether it was on the margin performance or it was a debt reduction. But the market seems still very, very nervous about these companies. What is your view on metals from here on?
So we own metals. We have positive view on the steel sector. So across our portfolios, metal will be in high single-digit exposure for us, and we are holding on to that. So when I said we are on the sideline, it is to add more exposure to metals, but we are happy with what we own. And we do have a positive view on the steel. Sector has done well, and maybe that's the reason markets are not reacting positively to the results, because these results were expected to be good. I think with a further reduction in raw material prices could be the next big trigger for the sector. And we are hoping for that.
Aman, we'll leave it to that. Thank you very much for joining in. That's the view from Abakkus Asset Management. By the way,